I'm here with Brad Lyons. Brad's our investment manager here at Wiser Wealth Management, and we're going to talk about some of these recent bank failures. I've gotten emails overnight asking about, is Charles Schwab really a place we want to have our money? Because the day after, or yesterday, of the day we were recording this, the small, mid-sized banks really started trading. In fact, there were over, I think, 50 banks yesterday that had a halt in their trading, mostly regional banks. Charles Schwab being one of those, which is not technically a bank, but I think just got sucked into the fray, so to speak.
Yes, they just got drawn into it because of their financial services industry,
right?
Sort of organization, and they have very large customer deposits in the Schwab fund.
So ultimately, though, this is all started with some fear over really just two closed banks at this point.
Yeah, the two closed banks are on in different industries as a clientele. The most well-known one that we're hearing about in the news was SVB, Silicon Valley Bank. At the time that it was taken over by regulators was it last Friday or over the weekend. It was the 16th largest bank in the United States with over $175 billion in assets. Mm-hmm. I mean, that's a very large bank.
Yeah, it is.
It's the second largest bank failure in U.S. history.
Wow.
Yeah. So
what do we think that got us to that point?
Well, there's a couple things that Silicon Valley Bank was involved with that led to this, failure, I guess. One, its clientele was fairly concentrated in the technology industry and the venture capital world. Okay, both are very important sectors in our U.S. economy relative to the technology sectors, large technology firms in the Silicon Valley, and then servicing those firms on a banking sense. So they had very unique services offered to a one specific industry. Then the second industry that they banked was the venture capital, which is even more unique. But it provides startup capital to small companies that grow and become new useful services that we all use and need in our economy. So what had happened was that a couple of years back, as they were growing at almost an exponential rate, taking in deposits, they were taking that money and then doing what banks often do is they buy long-term treasury securities with that, and they hold those as assets. The interest that's earned on that, they use to pay their depositors interest on their deposits and fund operations. So, however, at the beginning of last year, as interest rates began to rise, given there's an inverse relationship between bond prices and interest rates, as interest rates began to rise throughout 2022 and now into 2023, the value of those bonds that they held as collateral and as assets began to fall. So you have this inverse relationship between the value of the bonds was going down, interest rates were going up, okay? Mm-hmm. As the bank's clients began to withdraw money, the bank had to sell these assets to provide the cash, liquidity needs for the withdrawals. And once that began to happen, okay, they began to recognize losses in their capital structure. That word got out in the technology and venture capital world, and they all began withdrawing money. I think on March 9th alone, $42 billion was withdrawn from the bank. Wow, I was right.
Yeah. It's very interesting. A lot of that started on Twitter. There's a huge Twitter feed and talking about it, which basically created like a traditional run on the bank. Like
it was a run on the bank.
1920s, 1930s.
Exactly.
Right?
All done through social media.
Yeah. Well, back then it was by telephone, right? They're probably complaining about telephone back then, where now we're complaining about social media.
Right. And so the regulators stepped in, and now they're going to make all the depositors whole. Okay. Shareholders and bondholders will not be made whole. They're lower on the capital structure. Right. So whatever they get, or what they don't get, they don't get. But the depositors are going to be made whole. Even those depositors who had deposits in excess of the FDIC amounts.
Right.
FDIC.
Oh, wow.
Yes.
Over the 250.
Over the $250,000. We should explain a little bit, for our listeners. FDIC Insurance Corp insures depositors' money up to $250,000 per depositor,
per person, per entity,
account type, per bank.
Right.
Okay. So individuals can have an individual account insured up to $250,000. If you and a spouse each have $250,000 in an individual account, you're both insured. If you have a joint account, you're both insured there as well. Okay.
Right.
So,
and taxpayers didn't have to bail this company out simply because the insurance is paid for by the banks, goes into a fund to cover situations like this. Now, if we were to have more failures, that account's getting a little low now.
Right? It's lower than it was. Yes. So yes, and that's the thing. And so what has happened is the U.S. Treasury has stepped in with its new program to allow other banks to borrow money for up to 1 year, utilizing the full par value of the assets that they are currently owning in order to secure their bank depositors, so that they don't have to liquidate these assets in order to meet deposit withdrawal demands. Okay, so this is a brand new program that banks are now eligible for in order to create additional confidence in the system. Because really the banking system is all about confidence and trust.
Right.
You just believe that when you put your money in, that it's going to be available to you when you need it for withdrawal.
Yeah, and so they're assuring people, which now today, these same stocks that were sold off yesterday are now up 30, 40, 50%.
Oh, yes, the regional bank
this morning.
ETF is up, tremendously this morning. So, exactly. So there was a sell-off in bank stocks as investors were concerned about the value of the bankers', deposits. But now that the confidence is being restored, trust is being restored, and depositors are not as fearful as they were, and so therefore investors aren't.
Ironically, over the last few days, the same treasuries that dropped in value that hurt them are actually up fairly significantly over the last couple of days too. Yeah. So I'm sure, yeah. But okay, so what about the second bank?
I was just going to say the other one, Signature Bank, that had a fairly niche clientele as well, I understand. And one report, it was they do a lot of banking for law firms, and another report I saw they do some banking also for crypto type firms as well.
Okay.
So when it's like anything else, the diversify your revenue stream and your clientele base as much as you can in any industry promotes a broader revenue stream for you, so that should any one particular portion of the economy do less well than others, you're insulated from a 100% downturn, such as technology or venture capital or crypto or any other sector. So but what these unique bank models do is they serve very, very well the clientele that they're built to serve. Right. Unfortunately, that sector went south a little bit, and it affected the banks. Now, it's being contained to just that bank in each case. So we shouldn't see a spread of this throughout other banking systems.
So if you look at our clients and their banks at credit unions, their money at credit unions, their Wells Fargo, their Truist accounts, do we have any reason at this time to believe that this could spread to where there's a run on those type of banks?
Well, I don't think so. And from all the news reports and all the what is happening, the government providing backstops, they're calling them, for depositors and as well for banks to borrow from this new program, it doesn't appear that they're spreading over into other areas. Brokerage firms are insured through another insurance group, SPIC, Securities Investors Protection Corp, which insures not the valuation of the securities in the brokerage accounts, but rather the return of them to the investor in the event that the custodian fails. Okay.
And then many of the larger firms actually have additional insurance on top of that through like Lloyd's.
Exactly.
That cover additional, I think it's up to $8 million now, I believe. Somewhere in that ballpark.
So it's very, very large. Yeah. So SIPC Club covers up to $500,000, $250,000 in cash within the account.
It's just really ironic that So if you think of it from the bank manager standpoint, this is probably a very simplistic view of this, but if you think about it from their standpoint, they were told in 2021 that inflation wasn't that big a deal, that the Fed was not going to increase interest rates, definitely not going to increase interest rates, definitely not going to happen. And then January 1 of 2022 hit, and all of a sudden we're going to increase interest rates faster than any other time in American history, right?
Right.
And so for banks like that, if you're not managing your risk well, I'm sure immediately Treasury starts falling, and they didn't want to liquidate at that point and take those losses, I would assume.
Right.
So I don't know that this is just manager induced. I think the Fed probably should take some blame for it too. But that's it's just these are just very interesting times as we're coming out of also unprecedented times with all that stimulus from 2020.
There's still a tremendous amount of excess cash in the monetary system right now.
We're going to see probably other stresses in the economy.
It's very likely
as we get transition through this,
and this is going to cause additional volatility in the markets as well from time to time when things like this occur. Okay, that could not have been predicted. We could not have predicted that the technology firms and the venture capital firms all of a sudden began to withdraw money from Silicon Valley Bank for no apparent reason at the time, other than their fear of a run on a bank, and then it became
it started
prophecy.
because the bank was trying to sell some assets to create liquidity, which I think created the.
That's right. They were trying to go to the secondary markets and offer securities, additional stock and preferred stocks to raise capital. Well, once that got out, then instead of it being a confidence builder that they're raising capital, it was just the opposite. It became more of a, oh my gosh, there's something gone wrong.
Why do they need capital?
Why do they need capital? Yeah.
Right. Interesting.
Yeah.
Well, it sounds like as far as everyday people who are not venture capitalists or running technology firms, that we should give pause and maybe take a look at this. But ultimately, there's no reason to be adding fear to our daily lives over this right now.
No, none whatsoever.
All right, Brad. Thank you.
All right. Thank you.